Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris Rapeseed. From the support seen back in March and April from the neckline extension, currently 485 3/4, the August to September 2024 reverse head and shoulders button, has seen the market gain enough bullish energy that 3 weeks ago we saw a really strong looking weekly key reversal up from this base through the resistances at 491 3/4, then the July 21 low 497 3/4, then a resistance at 504 3/4, then through some pretty significant congestions dating from September 2012 between 513 3/4 to 519.5, and over, though not as yet, not stabilized over the bright red neckline extension, currently at 522. And that's to the April to August 2024 head and shoulders top. And even peaking just over the July 2023 high at 526.5. The move higher has been enough to see the start of the second leg for a large bullish halfway hesitation. The question now is from where do we measure the bullish halfway hesitation? Do we measure it from the changeover gap higher at the start of March or from the changeover move in early February? I thought about this and I've decided to look at both. Thus, for the March move, we have a primary target X up in the 507.5 area and a secondary harder to reach target up in the 521.5 area. Both these targets for this pattern have been achieved. For the February move, we had a primary target also in the 521.5 area, so already achieved. But we still have open a much harder to reach secondary target X up in the 544 3/4 area. I'll be interested to see if prices can manage target X, as we have the March 23 high at 540 3/4 in the way, as well as the January 25 high right on the target of 544 1/4. Now, we also had a late January to date bull channel. As you can see, it's currently 515 to 548 1/4, which I drew 8 weeks ago. I had hopes that this might help in any developments higher, but to be honest, it has been a limited success, and I have since downgraded it. But there is still something else, something new that I would like to draw your attention to. It is the dark blue mid-March to mid-April bullish Andrews pitchfork. And given its short duration, this nevertheless still looks good as an indicator of the current bullish angle of attack, especially the middle time, which is currently 524.5, which has this week pushed up over the bright red neckline extension, and I suspect may be the cause of what we have seen recently, some higher volatility. I'll be interested to see how good this Andrews pitchfork is at continuing to show the bullish angle of attack, especially as there is no what-if scenario, fallback scenario here. There is no possibility for this dark blue bullish Andrews pitchfork to become a shallower bullish shift pitchfork. So it is this pattern or something else. Winnipeg Canola. There have been a number of patterns that have developed here, some with direct influence on the market, some not so much, but only a few, it seems, with any possibility of showing the way. The recent rise started with the double bottom formed over December last year and January this year, and around the 50% absolute Fibonacci line at 606.90. This led to the first pattern here, and what was the most consistent one here, until April at least, and that was the December 25 and January 26 through to April 26 ascending expanding wedge pattern. This pattern was breached on the downside 6 weeks ago and broken 5 weeks ago, and as I said 4 weeks ago, and I quote, I am loath to lay out targets or even potentials below for one single reason. The bright red neckline extension is currently at 722 even of the October to November 2023 reverse head and shoulders pattern, which has seemingly absorbed the bearishness generated by the break lower and is acting as an attractor right now. I warned about this bright red neckline weeks ago. End of quote. Now this warning proved to be justified and fruitful, as though in the middle of April it was tested, pierced even, yet by the start of 3 weeks ago the bearishness had dissipated and we started a significant move higher up through the March high at 548.5, as well as the 2025 high made back in June last year up at 751.70, plus the July 21 low of 761.90, to finally halt at the March 2008 high at 770 even, which interestingly was an earlier all-time high. This break higher, though not as yet fully justified, still leads to what I said 2 weeks ago, and I quote, an early February to date bullish halfway hesitation, and possibly a late December 25 to date bullish halfway hesitation. Thus for the former, I would have a primary target X up in the 773 area, so close to the market. And a secondary harder to reach target X1 up in the 815.60 area. For the latter pattern, I would give it a primary target X2 up in the 810.60 area, and a secondary much harder to reach target X3 up in the 877.70 area, which is up off the top of my daily chart right now. I'll be interested to see how these patterns develop and whether the market will hold with the February base pattern or try for the harder December 2025 base pattern. End of quote. The jury is still out on this pattern, as it's overdue as a pattern, and the longer it takes, the less likely it may happen. This leads to my final point, perhaps the most important longer term pattern here. I spoke about it 11 weeks ago when I said, and I quote, I've drawn in the meantime a March to December 2025 bullish Andrews pitch hook, and I think the middle time, that's overhead currently at 808.60, I think this middle time may become important. End of quote. This pitch hook is now highlighted in bright pink, has had no tines, even now, no tines have been tested on this pattern bar the lower time back at the start, and that held. But I still think this pattern may become important in the future, so please, please, please bear it in mind. Bursa Malaysia crude palm oil. To start with, as I have done here for most of last year and now into 2026, I'd recognise the wide congestion area that was overhead, but which became a support, and now once again rapidly becoming an overhead congestion area, once again between 44.08 and up to 45.59. Prices which had since late March been up over it, bar one failed attempt lower mid-April, finally punched their way down through it yesterday, or day before yesterday, with the lowest low close since late October 2025. Please continue to remember this congestion area, as it is important. So, going back now to the rise in very early March, the reason for the strong rise is the development of another congestion zone, this time further below between November 25 to February 26. In fact, it was 3 bands of congestion made up from the lesser Fibonacci line at 40.26, then congestion at 39.86, and the February 2011 high at 39.53. These 3 eroded the bearishness we saw at the tail end of last year, and after a failed attempt higher in late January, which ended up in a V-top, we had a quite decent small February base double bottom Adam and Adam type. The apex of that move up was with a gapping move higher that peaked 10 weeks ago, just over, and then 9 weeks ago, just under, and with yet another move higher, a more sustained move higher, during the first 2 weeks of April, all over this one single dark blue neckline, which is currently at 47.74. It's a big old September 2015 to November 2018 head and shoulders top. However, this move higher ultimately failed at the bright red neckline extension, currently at 49.54. That's the big, not so old September 2015 to November 23 reverse head and shoulders pattern, and was just short of 2 important 50% Fibonacci lines, which are a little higher up. These 2 are the 50% Fibonacci line, the July 19 to March 22 move at 49.64, and the May 20 to March 22 move at 49.92. The subsequent drop was halted 4 weeks ago by erosion through the 44.08 to 45.59 congestion, and eventually at the time by the rising green short medium moving average, currently at 45.01 today. This at the time was not a major support on its own, but if you consider it sitting back then in the shadow of the congestion between 44.08 to 45.59, then I think it wasn't until this week a worthy support. Now, 2 weeks ago I asked the question here, and I quote, "However, the question here is the same as elsewhere in the veg oils and oilseeds. The capped higher and significant supports below. Is this market forming a topping action, or is it some form of bullish halfway hesitation? Whereas elsewhere the market have seemingly embraced the bullish initiative and gone to try higher. Here, well, here it is not so obvious, and indeed it's not so obvious if we are forming either a topping action or a bullish halfway hesitation. However, as I said 2 weeks ago, I would like to look at this market in a slightly different way and to consider the whole 2025, April 25 to date actions a really big, really large double bottom, or even a very large big W pattern. On this I am not sure as yet, but I would rather ask the question and look silly than even sillier later on when it may happen, so please continue watching this space." End of quote. Well, it seems the market has decided to pass on the idea of a really big double bottom, or the big W pattern idea. And this week prices broke down through the base of the big 44.08 to 45.59 congestion and the green short medium moving average down into a fairly free zone below that only starts seeing some supports at the combination of the mauve medium moving average, which is currently 43.08, and the gold a long moving average currently at 42.94, which together this week formed a golden cross. As well as nearby we have the combination of the 38.2% Fibonacci line of the May 20 to March 22 move and the 50% Fibonacci line of the May 23 to December 24 move, both at 42.74. So altogether some significant supports below. This move down has also allowed me to draw a new bright green early April to early May acute bearish Andrews pitchfork to perhaps, just perhaps, show the bearish angle of attack of this latest move lower. I am not in love with this bearish Andrews pitchfork, and I'm quite prepared to finesse it to a shallower bearish shift pitchfork in a heartbeat, if needed, or even to retire it completely if need be. Right now we are between the overhead bright green upper time, which is currently at 45.17, and the bright green middle time below, currently at 42.12. This brings me to my final point, and that is to look at the whole start of April to date action as a possible bearish halfway hesitation. We seem committed to the idea, but we have so many significant supports not too far below. However, I will lay out some targets anyway below, even though I'm not certain on their validity as yet. Thus, in this move down, we would have a primary target at 43.74, a target that was reached earlier this week, and a secondary harder to reach target X, target X, down at 41.66. I am at this time skeptical as to whether prices will reach down as far as target X. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.